Hello and welcome back. My name is Angelo Zittis and this is the IronFX week ahead report for March 28th to the 1st of April. So as always, our week ahead report is carefully put together for the traders that like to be aware and prepared for what the market will offer in the days to come. Among the top characteristics of a successful trader is the hard work of preparation. This report can be used as a window for what the following days may look like, while at the same time provide information of the current happenings in the economies around the world. Even though the financial markets are extremely broad and cover for a considerable amount of instruments, this report will be focusing on some of the major Forex pairs, including the greenback, the euro, the British pound, the Australian and Canadian dollars, along with the Japanese yen. Our main goal is to provide a detailed analysis of all the pre-mentioned markets and subsequently to support traders with accurate information to trade with confidence and possibly minimum risk. So we make a start first with the US dollar. On a weekly basis, the greenback's strongest movement was carried out against the JPY, which is currently trading at multi-year high levels. Yet, in the current week, the dollar continues to be in red territory against the AUD, the NZD, the CAD, and has shown limited movement against the euro and GBP. Yesterday, the 24th of March, the US preliminary market PMI manufacturing services and composite figures for March came out higher than the previous ones, dismissing expectations for a drop. The readings tend to highlight the FOMC views on important indicators of the economy showing continuous strength. On the monetary policy front, FOMC's chair Jerome Powell's speech at the 38th Annual Economic Policy Conference for the National Association for Business Economics stands out, and some comments could be hinting what is to take place in the following months. Jay Powell stated that the labor market is very strong and inflation is much too high, emphasizing two key points that are currently concerning the economy. On the labor market front, Powell noted it remains extremely tight, providing also the notion that employment was even stronger compared to the pre-pandemic levels, allowing people to change jobs easily for higher pay. These comments may be useful to consider if traders are targeting the employment report incoming on the 1st of April. The FOMC chairman admitted that the rise in inflation was significantly higher and more persistent than what the general market initially forecasted, stating the supply chain bottlenecks and the simultaneous strong demand for goods have supported inflation rates. Moreover, Jay Powell signaled further rate hikes to come, mentioning the median projection that accompanied last week's 25 basis points rate increase showed the federal funds rate at 1.9% by the end of this year. You're currently seeing the movement today for the dollar against other currencies. And another comment about the FOMC's chairman during and after his speech, the USD gained across the board and most evidently against the JPY. The past week was also characterized by the very notable rise in US Treasury yields, with the FOMC eager to retrieve monetary stimulus and increase the interest rate in the following months. A selling for the bonds has been enacted, which tends to lift yields substantially. Today, the 10-year US Treasury yields reached 2.37%, which is a multi-year high level. Higher bond yields tend to signal worries for the future of the economy. An interesting report by the Financial Times stated that some traders are doubtful whether the Fed can control heightening inflationary pressures. So, in terms of financial releases from the US coming up in the next week, we start first on the 29th of March with the consumer confidence figure from March. On the 30th of March, we get the GDP deflator, and the core PCE price final rates, all for Q4. Moving to the 31st of March, we get the weekly initial jobless claims along with the consumption adjusted rate for February. On the 1st of April, we get the start of the week with the US employment report for March, which includes the non-farm payrolls, the unemployment rate, and the average earnings year-on-year rate. On the same day, a little bit later, we get the market manufacturing PMI final and the very important ISM manufacturing PMI figures, both for March. This is the USD index 4-hour chart. As you can see, even though the dollar was able to remain at high levels, this is the multi-year high level, just below its trading in the current week, it is currently moving in a tight range between the R1 98.95 and the S1 98.40 support level. Now this is a tight sideways motion. However, in a more long-term view, as I said, the US dollar and the US index continues to move higher. Other levels we have noted which are significant from our point of view are the R2 99.40. If this level is breached, this could be a signal of a very strong bullish market, as this would signal a new multi-year high. And the R3 99.85 could be the next target, while if the sideways motion continues and the S1 is breached and the S2 97.85 is tested, then we could be moving into a sideways motion with bearish tendencies, and in that case we could see the 97.30 level coming into play. But overall, the RSI indicator remains above 50, thus we keep the sideways motion with bullish tendencies as our personal view. And we move now to the euro. So on a weekly basis, the euro is down across the board and has made gains only on Euro Jpy. Euro traders got what was expected in the past days, with most of the important economic releases dropping compared to previous months. On Thursday, the preliminary PMIs across the Eurozone provided information on the performance of key sectors. Eurozone and German manufacturing and services preliminary PMIs were better than expected but dropped below the previous month's readings. The readings could be evidence that the largest economies of the Eurozone have been dealing with the ongoing uncertainty much more efficiently than analysts expected. On a side note, a release that stood out on Thursday was France's services PMI, which was higher than both previous and expected figures. This is today's, the image that you're looking at currently is today's euro movement against the other major currencies. On a separate note, Europe is the area most affected by the ongoing war in Ukraine, with a list of matters currently concerning the bloc. Ukrainian refugees, supply issues, and much higher commodities and energy prices are among the most important issues at the moment. Moreover, the ECB said it would be tightening relaxed bank funding rules it introduced in response to the coronavirus pandemic, despite worries that the Ukrainian war could introduce new challenges. For the Euro traders interested in the financial releases from Europe in the following week, we start on the 29th of March with Germany's GfK consumer sentiment for April. On the 30th of March, we get the Eurozone final consumer confidence and the Eurozone economic sentiment, both for March. On the same day, we get Germany's preliminary HICP data for March. On the 31st of March, we get France's preliminary HICP data and Germany's employment report, both for March, along with the Eurozone unemployment rate for February. On Friday, the 1st of April, we get the German and Eurozone final market manufacturing data and the crucial Eurozone flash HICP rates, all for March. In terms of other economic releases from Europe, which do not relate to the euro, however, we have noted a few for traders to keep in mind. For traders following the CHF, it could be useful to monitor Switzerland's KOF indicator for March, coming up on the 30th of March. On a separate note, we would also like to mention the Czech Republic's CNB repo rate announced on the 31st of March, which could produce a volatile session for CZK currency pairs. And this is Euro USD's 4-hour chart. Sideways movement between the R1 110.60 and the S1 1.0965. I would suggest that the currency pair is currently moving in a sideways motion, a wider sideways motion between the R2 1.1130 and the S2 1.0905, and this motion has been basically going on for most of March. Thus, we keep a sideways bias for this currency pair, and I'm going to leave it there. I'm going to leave the choice to traders depending on the direction they would like to view. We move now to the pound. On a weekly basis, the pound continues to gain against the euro, the USD, and notably against the JPY. In the current week, the UK CPI rates for February jumped higher than both previous and forecasted rates. Also yesterday, the March flash services PMI came out higher than the previous and expected figure, while the manufacturing figure dropped, providing some mixed signals for the economy. Yet the pound may have been unable to advance in the past days as Chancellor of Exchequer Rishi Sunak was in the epicenter of the market's attention, with criticism attached to his name through various media sites. With a number of new measures in the UK's spring budget, including employment allowances, reducing fuel duty on petrol and diesel, and others, Rishi Sunak had to defend himself over claims that he wasn't doing enough to help the poorest. The finance minister may be in a difficult position at the moment, as many estimate the new measures may not support but even push more people into poverty. The news may have sent the GBP in a sell-off on Wednesday, as it lost ground against the euro and the USD and continued to do so on Thursday. An interesting set of important comments was provided through BOE's Financial Policy Summary and Record, published on the 24th of March, yesterday. It was stated that even though UK house price inflation remained high, very little evidence of a deterioration in lending standards or a material increase in the number of highly indebted households was provided. Yet higher costs of living is now evident, first due to the rising energy prices and second due to the import prices, which will affect the general public, but mostly lower income households. Moreover, in the same report, the Bank of England began outlining Britain's first regulatory framework for digital assets, cryptocurrencies, crypto assets, saying that despite the sector remaining small, its rapid growth could pose risks to financial stability in the future if left unregulated. For the economic data coming up next week, we note the GDP rates for Q4 and the nationwide house price rates for March, both to be released on the 31st of March. Finally, on the 1st of April, we get the final market manufacturing figure for March. We move now to our technical analysis. This is GBP 4-hour chart. So at the moment, we're seeing a sideways motion, but in the past week, GBP has been moving higher. Now this chart displays an upward movement, but the sideways movement commenced upon the comments we made on Rishi Sunak's criticism in the media, and this may have kept the pound a little bit lower. So at the moment we see a testing of the S1 1.3175. If this level is breached, then we view the S2 1.3125 as the next possible stop lower. Even lower, the 1.3085 could also come into play, but the S4 1.3020 level is the lowest level reached so far in March and the lowest level so far in 2022, so it is worth keeping in mind. Upwards, we could say that the R1, the 1.3285 level, is the most probable stop if the bulls are to take control of the currency pair, and higher we have the R2 1.3345 and the R3 1.3405 as levels that could be reached in an intense bullish scenario. We move now to the Australian dollar. Excuse me. We move now to JPY. So in the current week, the JPY sell-off across the board was the most intense among major currencies, with the yen losing considerable ground against all Euro, GBP, and the USD. Still, the ongoing weakening of the JPY across the board, and especially against the USD, may be considered beneficial for the export-oriented Japanese economy overall. Haruhiko Kuroda, the governor of the Bank of Japan, today displayed concerns over inflationary pressures, including the notion that Japan's inflation increase has been lower compared to its trade partners. On a separate note, according to Bloomberg, the Japanese government, may be considering fiscal stimulus measures amid rising prices to support the economy. Yet the ongoing rise in energy prices may not be so favorable at this time, as the Japanese are still facing reduced consumer spending. However, on a positive note, in the past days, flash manufacturing Jibun PMI seasonally adjusted figure was higher than the prior months, displaying some strength for the sector. For JPY traders interested in the next week's economic calendar, we start on the 29th of March with the Japanese employment data for February. On the 30th of March, we get the preliminary industrial output for February. Finally, on the 1st of April, we get the Tankan, big manufacturing and non-manufacturing figures for the first quarter of 2022, along with the final Jibun manufacturing PMI seasonally adjusted figure for March. We move now to USD Jpy's 4-hour chart. This technical analysis, clear upward trend. USD Jpy was among the strongest to the upside major currency pairs for this week. In the past sessions, we saw an approach of the R1 122.55 level. It wasn't really tested or breached. The price action was just below it, and in the most recent sessions we see a correction to lower grounds. However, as the price action remains above the upward trend line, which is currently seen on our chart, we suggest the currency pair remains in an upward momentum. In case a downward trend, in case the recent downward trend continues, then the S1 120.25 could be visited. But at the moment, the currency pair remains in an upward momentum. Moving now to Australia. So on a weekly basis, the AUD has made a decisive movement upwards against the US dollar and remains currently nearby break-even levels against the euro and the GBP. In the past days, Australia's flash PMI data strengthened in all three sectors, providing a positive sentiment that operations in key areas like manufacturing, services, and the composite are supporting and are expanding the economy. On the other hand, Australia continues to face a red-hot property market. So much information is written about this subject, and prices are skyrocketing in the current and the previous year. A considerable amount of people trying to buy their first house are finding it extremely difficult to get a bargain at this point. According to the Financial Times, as a result of the ongoing property crisis, Australia has accumulated enormous household debt, which as a percentage of gross domestic product has reached 120%. Even though we still have time until the next RBA meeting, policy rate currently states a 91% probability for the Reserve Bank of Australia to remain on hold. In terms of financial releases in the next week that could move the AUD, on the 29th of March, we expect the final retail sales rates for February, and on the 31st of March, we get the building approvals rate for February, along with the Chinese NBS manufacturing PMI figure for March. Finally, on the 1st of April, we get the Chinese final Gaixin manufacturing PMIs for March. And we move now to the AUD USD for our chart. So AUD USD, the Australian dollar along with the Canadian dollar have been causing a lot of problems for the USD in the current week. So as you can see, AUD USD remains in an upward momentum. It currently tested and temporarily breached the R1 0.7520 level. If this level is clearly breached, then we could see a move to the R2 0.7545 line, and even higher the R3 0.7580. These are the levels if the upward momentum continues. In the opposite direction, if a selling trend takes over, we could see a move to the S1 0.7455 level. And lower than that, we may see a move to the S2 0.7425 level. But overall, if you check out the RSI indicator below our chart, is currently very near to the 70 level, implying an overbought market. So now we move to Canada. So the CAD has been among the very few currencies that continues to impress traders with its strength against the USD in the current week, despite no major economic releases. Moreover, the CAD is down on a weekly basis against both the Euro and the GBP. Economic releases from Canada that could be of interest to traders include the GDP rate for January on the 31st of March and the Market Manufacturing PMI seasonally adjusted figure for March, coming up on the 1st of April. And this is USD CAD's 4-hour chart. We have seen an attempt of the S1 1.2510 level in the most recent sessions. However, the price action rebounded and could be heading to the R1 1.2555 level. The downward momentum, even though has been breached in its intensity has been breached, it remains in a downward trend. But as you can see, the price action the downward trend could be easing, we could say. In case of a rebound, we may see a move above the R1 and the price action could be heading to the R2 1.2595 level, or even the R3 1.2635. If the downward momentum continues below the S1, we see the S2 1.2460 as the most probable next stop for the bears. So we have also added a small comment for the oil market, as Canada is strongly related to the oil market. It's involved and contribution to the oil market allows us to place this comment. So WTI prices extended their gains in the past days. On Wednesday, surpassing $110 per barrel after news that the Caspian pipeline, which runs between Russia and Kazakhstan, was disrupted due to damages from bad weather. Also, various sources seem to point out the other major economies will continue to pressure Russia with new sanctions. Thus, Russian oil distribution may be hit further. In terms of economic releases, we note the 29th of March when we get the API weekly crude oil stocks figure, while on the 31st of March we get the EIA weekly crude stocks figure, and the very important OPEC meeting. Everybody in the media is talking about higher energy prices, and OPEC has a lot to do with what is happening with pricing. Thus, we would suggest that oil traders keep closer to be involved into monitoring what is happening with updates on the OPEC meeting. And this is WTI's 4-hour chart. So at the moment, we have seen that the upward momentum that was formed has been basically breached. But overall, oil prices seem to be moving in a wider sideways range between the R4 126 level and the S3 93.75. If you close it a little bit more, you could see that there is a sideways motion between the R1 115.15 level and the S2 101.35. But overall, WTI prices remain very, very high, extremely high, and the current uncertainty derived from the ongoing inflationary pressures and the ongoing supply bottlenecks, and in addition, the very sad happenings in Ukraine are all affecting what is happening with the energy prices and especially the oil market. Thus, as I said, we would suggest for traders to closely monitor what will happen with the OPEC meeting on the 31st of March. So that's the end of this weekly report. We hope you can use this information to your advantage from everyone here at IronFX and me, myself, Angelos Zitis. Enjoy a great weekend and stay safe.